Your brain is working against your wealth, and the fix is about as exciting as watching paint dry. According to DALBAR's 2025 Quantitative Analysis of Investor Behavior Report, the most comprehensive study of real investor performance in America, the average equity investor earned 16.54% in 2024, while the Standard & Poor's 500 index returned 25.02% over that same period. That 8.48 percentage point gap is the second largest investor underperformance recorded in the past decade. The market had a fantastic year. The average person left nearly a third of those gains on the table. And the reason had nothing to do with the quality of the investments people chose. It had everything to do with behavior. Here's the thing most people never learn about investing. The gap between what the market returns and what investors actually receive is not a knowledge problem. You do not close it by learning more. You do not close it by finding better stocks or smarter strategies. You close it by doing less. That sounds simple, almost insultingly simple, until you understand why it is so brutally hard. And that reason starts inside your own brain. Research in neuroeconomics has identified striking biological similarities between how the brain responds to cocaine and how it responds to the anticipation of financial reward. Hans Breiter at Northwestern Medical School and other researchers have documented what journalist Jason Zweig later called the prediction addiction, the brain's compulsion to seek exciting, unpredictable outcomes, even when the rational choice is clear. When you check a stock app and see a green arrow, your brain releases dopamine. When you watch a trade you placed go up in real time, your brain registers that as a reward signal. The problem is that your brain cannot distinguish between a well-reasoned financial decision and a slot machine pull. Both feel thrilling. Both produce the same neurochemical response. This is not a character flaw. It is not laziness or stupidity. It is biology. And in 2025, the financial industry has never been more effective at exploiting it. Professor Ryan Moss at the University of Colorado Boulder, whose January 2025 research examined the surge in retail speculation, put it directly. You see a headline, you place a trade, and if things swing your way, you get an immediate sense of victory. The problem, he noted, is that the excitement consistently overshadows rational decision-making, pushing people to take on more risk than they planned or to chase losses back toward even. By the end of 2024, roughly 10.2 billion equity options contracts had traded in a single year, approximately double the volume from before the pandemic. That is not sophisticated investing growing in America. That is the dopamine economy growing in America. And here is what that excitement is actually costing people in real dollar terms. Morningstar's research found that over the past 10 years, investors in American mutual funds and exchange-traded funds earned 7.0% annually, while the funds themselves returned 8.2%. A 1.2 percentage point annual gap sounds small. Over a decade, applied to a growing portfolio, it translates into roughly 15% of total potential returns simply evaporating due to behavior. Not bad investments, but bad timing, emotional exits, and performance chasing. A 2025 analysis cited by Morningstar found that the average holding period for an equity fund in 2024 had dropped to 4.79 years, barely half the length of a full market cycle. People are not giving their strategies time to work. They are reacting. Think about it this way. In 2024, a hypothetical investor who started the year with $100,000 in the Standard & Poor's 500 and simply did nothing ended the year with $125,020. The average investor, as tracked by DALBAR's methodology, ended that same year with $112,774. That is more than $12,000 lost in a single year, not to a bad market, not to a financial setback, but to the act of moving money around at the wrong times. That pattern compounds brutally. DALBAR's 20-year data through December 2024 shows the average equity investor earned 9.24% annually, while the Standard & Poor's 500 returned 10.35% annually over that period. 1% per year sounds like rounding error. On $100,000 over 20 years, that difference translates to more than $100,000 in missing wealth. That is the cost of excitement. That is what the dopamine economy takes from you, quietly, every year, while you feel like you are doing something smart. What does boring look like instead? It looks like this: a low-cost, broad market index fund, something that tracks the total American stock market or the Standard & Poor's 500, purchased on a regular schedule, held without touching it for decades. You do not need to monitor it daily. You do not need a strategy for every earnings report or Federal Reserve announcement. You certainly do not need to sell when the news feels alarming. You just need to let compounding work, which is the single most counterintuitive thing about wealth building. Compounding front-loads the boring and back-loads the extraordinary. Morgan Housel, the behavioral finance author and partner at the Collaborative Fund, explained this better than almost anyone when he pointed out that 99% of Warren Buffett's net worth was accumulated after his 65th birthday. Not because Buffett suddenly got smarter, not because he found better companies, simply because compounding is a function of time raised to a power. The longer the exponent, the more violent the outcome. Housel also noted something that deserves to sit with you for a minute. Nothing is more damaging to your investing psychology than getting rich quick when you are young. Early wins create a belief that financial markets are predictable and skill-dependent. They make you feel like you understand something other people do not. And that belief is where most self-inflicted financial setbacks begin. Paul Samuelson, the Nobel Prize-winning economist, said it plainly. Investing should be dull. It should not be exciting. The reason that quote has survived decades is that it identifies a real asymmetry. The strategies that feel most satisfying in the moment are systematically the ones that underperform over time, and the strategies that feel least satisfying are the ones the evidence consistently supports. Let's talk about the specific self-sabotaging behaviors that derail people, because knowing the pattern is the first step to breaking it. The first is performance chasing. A sector or individual stock has a great quarter. It appears everywhere in financial media. You buy in after the run-up has already happened, hoping the momentum continues. It rarely does. Morningstar's Active-Passive Barometer, published through June 2025, found that over the 10-year period ending at that date, only 21% of actively managed funds both survived and outperformed their passive counterparts. For American large-cap funds specifically, that number drops to 8%. 8. That means roughly 92 out of every 100 active managers failed to beat a strategy you could execute for nearly zero cost. The second behavior is what DALBAR calls the late re-entry. In 2024, equity fund withdrawals occurred in every single quarter. The largest outflows happened just before the market's biggest return surge. People left to protect themselves from further softness and missed the recovery entirely. The timing was almost perfectly wrong. Not because investors are irrational, but because the emotional pressure to act peaks at exactly the wrong moment. Fear feels like wisdom when it arrives. The third is misreading complexity as sophistication. Morningstar's data shows that the more complicated, volatile, or trend-driven a fund is, the wider the investor return gap grows. High turnover strategies and sector-specific bets tempt frequent trading. And the more you trade, the more ground you systematically lose. Here is the concrete step that belongs in your calendar this week, because information without action is just entertainment. Open your retirement or brokerage account and look at how many times you have moved money, changed allocations, sold positions, shifted between funds in the past 12 months. Count the moves. For most people, that number is higher than they expect, because each move felt justified in the moment. Each one felt like the smart response to real information. Now ask yourself how many of those moves you made toward excitement and away from boredom. How many were responses to headlines, social media, or the electric feeling of a big market move? If the answer is more than zero, you have found the leak in your financial system. The next step is not to find a better investment. The step is to build a rule, written down, shared with someone you trust, that prevents discretionary trades outside of your scheduled contribution dates. Behavioral economists call these pre-commitment devices. You make the rule before the emotion arrives, so the rule does the work the emotion cannot. Index your core holdings in a low-cost, broad market fund. Schedule automatic contributions. Set a calendar reminder to review once per quarter, not once per day. And when everything in you wants to react, remember that your desire to act is the signal that you should not. The wealthiest outcome is almost always the least interesting process. That gap between what the market offers and what investors capture does not exist because the market is unfair. It exists because the brain that served your ancestors in environments of immediate threat is genuinely bad at navigating environments of delayed reward. The detox is not about withdrawing from investing. It is about withdrawing from the stimulation that masquerades as strategy. That is the core of what next-gen finance is built on, giving you the frameworks and the behavioral science to make better decisions with the money you actually have, not the theoretical decisions you imagine you would make in a calmer moment. If you want to keep building on this kind of thinking, subscribing means every new framework comes directly to you. Research-backed, behavior-focused, and designed specifically for people who are serious about building wealth over time rather than just feeling active about it. Leave me a comment with one honest answer to this question. In the past year, what was the most emotionally driven financial move you made? And looking back, do you think it helped you or cost you? I read every single comment, and your answer genuinely shapes future content on this channel. This video is for educational purposes only and is not financial or investment advice. Please do your own research and consult a licensed financial professional before making any financial decisions.